Great. Thanks for the introduction, and hi to everyone. I'm very glad to be here with my colleagues here. I would like to say that for us it's very interesting to share views on the B2B space because we are running currently a fund of fund strategy, and we have a strong focus on B2B. We think there are very good opportunities in this sector. Obviously, we complement also with the B2C side, but we see some good opportunities in the B2B space. So I'm glad to share views with you and to hear about your experiences. And probably I would like to give you the floor to each one to give a brief introduction. We have 23 minutes, so we have to run.
Yep.
And I guess people is hungry now. So yeah, probably we can start with Marvin.
Okay, great. Hi, everyone. My name is Marvin. I'm a partner at 500 Startups. I actually represent 500 Startups from San Francisco. If you don't know 500 Startups, we've been around for 8 years, probably better known for the accelerator. You know, everyone knows this as a consumer firm, focused firm, which is actually incorrect. So if you actually look at a lot of the firm's winners, SendGrid, Twilio, TalkDesk, all on the B2B side. And from my side, actually, my best performing companies are actually on the B2B side. So companies like ManyChat, Aircall, Pipefy, Rapid API are just some that hopefully people have heard. Chippo is another one. And so it's actually an area that we actually have done a lot of deals in, and we do like the space.
I see. Probably Gonzalo, you can explain a little bit the background.
Thank you very much for the invitation, for the organization. It's better and better each year, more people. From my side, I represent Faraday Venture Partners, which is a private investors club here in Spain. We've invested up until now in 27 companies, half of them B2C, half of them B2B, more or less. So glad to be around to discuss.
Hi, my name is Gil. I'm an American lost in Europe, American-Israeli lost in Europe. I've been doing venture since 2003. I founded Angular Ventures about a year ago, basically to bring what I would call the Israeli model of VC to Europe. What we do is we invest only in early stage enterprise technology companies anywhere in Europe or Israel, usually companies that are focused on the US market from day one. So we have in the Angular portfolio 12 companies already. Out of those, 9 of them are incorporated in Delaware, and 5 of them have American VCs backing them, and 3 or 4 of them are already headquartered in the US. So we're very focused on helping companies go global very quickly. That's what I've been doing for 15 years now, so 100% B2B.
So hi, thank you, Mauro, and thanks for the organization, especially to Maria. She rocks, and we're here because of her. She pushed this a long time ago. My name is Iñaki Arrola. I, long time ago, founded an internet company called Coches.com. Which is not that innovative, but actually what we're doing is investing since 2009 in companies. Firstly, individually, and afterwards through funds. The name of my fund is K Fund. We are agnostic in a way of seeing this panel. So we invest in B2B and also B2C. Having said that, we are investing more in B2B lately, like around 70% of the investments are B2B.
Great. Well, probably we can start speaking about the basic overview on the venture capital industry. I just saw today that Europe already reached 28 billion on investments. This is going to be a record year for Europe once again, surpassing what the level observed last year. In the B2B space is even more important the role that is playing now corporate venture capitals, investing more and more. That's another trend that we observe. So I would like to probably see your view on both ideas. No? How is affecting the deal terms, the deal flow, the valuations, the current level of money in the market in the European, although we believe in Europe there is still a huge funding gap. So even with this exponential growth, we see an opportunity here. But what's your view on that? And how is changing the game, the fact of having more corporates investing more and more and very early? How has been your experience co-investing with them? A little about your views on both.
That's like a lot of questions. Maybe what I'll do is maybe I'll answer the corporate one because I actually have pretty strong views on it. I actually think it's, in some ways, in the long term, I think corporates are much better investing and working with startups in the later stage, so from Series B onwards. You know, I would think prior to that, I don't think they're very good. But I think like there are some exceptions, and we talked about in the room earlier. Like I think like there are some specific B2B focused corporate VCs that I think are good. So I think Microsoft is pretty good, but they focus from Series B onwards. I also think that Salesforce Ventures is pretty good. I think everybody else kind of sucks.
Yeah. In fact, in our experience, when we see funds with a lot of corporates as investors, the track record, the performance that we observe is normally not as good as VCs that have more financial investors, no, as LPs.
I think the challenge, and I think there's reasons why I think corporates suck, right, in sort of like investing. Number one, it's not their core business. I also think a lot of the terms they put in are also not great. I also do think that there's also some signaling risk, particularly in the early stage, because there are actually quite a lot of early stage investors in Series C or Series A, and I actually think it's very, very weird if, like, unless you're in pharma and you're in a biotech company, I think it's very, very weird as a software company where there's still a lot of very, very good early stage investors, and for me the signal is like, well, wait a minute, that just means that you kind of went around the block and you couldn't get investors from anybody else. You couldn't get financial investors, so you had to go to a crappy corporate VC. In early stage, for the record. So, sorry, that's...
Yeah, to continue with the corporate venture capital things, I don't particularly like it. The thing is that there's no rules. Each situation is special and particular to that company and that corporate each time, but what we ask the founders to think about is why do you need this corporate? Because we need money, and then you don't need this corporate, you need the money. No, because we want to use them to sell through B2B2C schema or whatever, or then you don't need their money then. So it's very difficult to find a situation when they do need that money and there's not going to be a conflict of interest, because at the end of the day, okay, I want to do your B2B2C, but I want to do it with as many corporates as I can. The fact is that I have your stake in my company, and that could represent a conflict of interest for my commercial expansion at a very early stage. I don't know if you were saying about that.
That's what I mean.
So you need to take it, every situation is special, and we're all looking for outliers, and it's very difficult to make an average. But if you can avoid it, I mean, if you could avoid VCs as well, it's even better. Just by financing by your clients, you know, whether they're B2Bs or B2Cs. But if you cannot, and if there's a very good value that you can take from this corporate venture capital, at least in the shareholders' agreements, make sure that they're not going to be able to veto another commercial relationship with a competitor of his, for example.
Yeah. Clean term sheets are super important.
Yeah.
So I agree with the comments on corporates. Let me maybe turn to something else you mentioned, which is the Zeitgeist. You know, where are we right now in tech land and VC land? I think I'm too old to remember parties, but there's that point in the party when like it's 1 in the morning or 3 in the morning and you're out of food and everyone's drunk and a whole bunch of people you didn't invite have shown up and no one remembers why they came in the first place. I think that's where we are in tech venture capital. And some of those people that weren't invited are the corporates, by the way. So like everyone has money, everybody has a fund, every corporate has a venture arm this and a venture arm that. Funds that used to be 20 million are now 120 million. Funds that used to be 200 million are now 800 million. And rounds that used to be 2 million are now 20 million. Multiples that used to be 5x are now 20x or 40x. And that's not sustainable for very long. And I think in the enterprise sector, we've seen a micro boom within that boom. So suddenly everybody's a B2B investor. Everyone's reinventing themselves as a B2B investor. And a lot of phrases are getting misused by VCs and even by founders. Phrases like deep tech or phrases like AI or machine learning or automation or any of these things. So I think what that means is it actually creates a very dangerous environment, particularly for enterprise founders, because there's a lot of distractions. There's a lot of sources of capital that are not optimal. There's a lot of companies out there with budgets, with innovation teams that really want to waste your time and have you show up and deploy something, and they'll give you a proof of concept or a pilot or a letter of intent or some other thing. And a lot of that ends up being a distraction from actually going out and building a business. And I think when you think about, as an early stage founder, an early stage fund, what is it that we're trying to do? What we're trying to do is get to Series A. What is a rational Series A? A rational Series A is if I give you $10 million or between $5 and $15 million, can you hire a bunch of salespeople and can they sell this thing? Can you bring someone off the street, train that person to sell, and can that person carry quota and pay their salary and become profitable for the business and so on? If you can prove in Series A you can do that with 5 sales guys, then you get a Series B of 40 million, you can hire 20 sales guys. And so we as seed investors, we've got to figure out, can we map to a Series A? And we're in a very dangerous environment right now because people are overpricing rounds and raising too much and over-diluting, do all kinds of strange things that make that navigating that path very difficult, particularly in enterprise. And so that's something that we at Angular are spending a lot of time trying to find founders that are hopefully doing things that are so contrarian or so unsexy or so boring that no one's paying attention to them, and we can actually help them build a real business while everyone else is doing these overpriced rounds. That's kind of, in a nutshell, what we're trying to do. So oil and gas software, ag tech prediction, supply chain stuff, HR reporting tech, those kind of things that hopefully no one really wants to fund. The other thing I'll just add to that is because of this overhang of capital, if you're the best founder in a space and you've raised money from a great VC, it used to be that 5 years ago you might have 2 competitors. Right now you have 10 competitors whose websites all say exactly the same stuff that you say. And as soon as your funding round gets announced, all those other competitors go to your website, and if you have some good marketing language, they just copy it, right? And so it's complete chaos for customers because customers are like, well, there's 10 companies like this that are saying exactly the same thing. And so that makes it even more complicated to execute. Even if you can fundraise, executing and selling is much more complicated now in this kind of bubble days than it has ever been before.
The noise. Oh,
the
there's
noise,
so much
tons
noise.
of noise. Yeah. So that's kind of what the $28 billion translates to is a ton of noise, not just for us, but for founders and for customers.
Yeah. And you think about 70 billion in the US, it's retarded.
Yeah. There's no way we're going to get a return on that as an asset class, right? So it's going to get very, very dangerous. I mean, Adam Neumann is walking around barefoot in the streets of New York, right? So things are starting to change.
I'll also add on top of that 2 things, and then I'll go to Spain if then
yes.
we will have reply to everything. One is that we tend to speak a stupid language, and we are normal people, and too many times we are like, hello, I'm an investor, and I really hate these situations in which investors, we do believe we are something because we are just investors. So please bear in mind we're stupid, first of all. Not all of them, but me, I am. On top of that, what I think is that in Spain we're not yet there. I don't know if we're going to go to that party or not, but that 28 billion, I don't know how much will represent in Spain, but probably will be like around 300 million, to say something, 400 million, 500 million, that's it. So if you compare it with the size of Europe, we are a small island somewhere, which I think it's a nice opportunity for us. And I think it's also being seen by foreign investors like a place like, hey, the party's not yet there, and maybe we can make more rational investments. And if the winner comes, probably, I don't know, we're going to stay on the same situation, or maybe we'll go a little bit lower, but we're not going to crash, especially on the seed phase. So I think there's nice news over here. We started later. The ecosystem started later. We are also a nice place to live, and we have Madrid and Barcelona as the most important poles in Spain. So I think there's also a little bit of news in an island under the Pyrenees, which is called Spain.
Yeah. Well, my view is a little more positive on the pan-European landscape. I agree that it's a lot of more money than in the past. But my feeling, my sensation is that still valuation has not reached the level of the US, and that is especially true in growth, late stage, and that's the reason why I think we see more and more international VCs coming to invest in Europe, even now, with the valuations. which is a challenge, I think, for an opportunity at the same time, because probably for early investors, now we are going to see earlier exit opportunities coming from these international players, no? But at the same time, what we see is that some multi-stage players with a pan-European focus are also moving down in the value chain, investing earlier than before, looking for the opportunities. So at the end, I agree that it's challenging environment. However, I don't know, how do you compare valuations, for example, Michael and Marvin? Do you think we are reaching that level?
I mean, the valuations in Europe are still relatively low, right? I mean, when I first started investing professionally over 6 years ago, like, you know, a typical seed round, like maybe 3 to 4 mil caps, and now it's like 10 to 15, which makes no sense to me because the quality level of the companies aren't substantially better. And I think it's just the inflow of money in general. I do think it's starting to slowly sort of like equalize in general. So, but at the end of the day, like I think the valuations just, it's one indicator. I think if you're purely investing on valuation, high, low, whatever, you probably shouldn't be investing. I think it's ultimately the great teams, right? Yeah. And so, and I do see that there's a little bit of binariness of just, for example, and this is maybe in line with B2B, which we're talking about. Like, I actually think in B2B versus B2C, right? I think it's very, you do not see a lot of consistently successful B2C consumers. And so B2C investments, B2C founders, because it's like catching lightning in a bottle. I do think you see a lot of consistent, like, serial entrepreneurs in B2B selling to enterprise, the skill set that you have and the relationships you develop. Corporates don't change that much. That's part of the reason they suck at innovation, right? But selling to them, it doesn't change very much in general. And so you accrue a lot of knowledge as you know, as an entrepreneur. For example, like, I'm not joking, there's literally 5 or 6 teams at Cisco. Like, they sell into Cisco, they literally sell to Cisco, Cisco acquires them, they stay for a couple of years, they leave, they start another company, and then they sell back to Cisco like several years later on. There's a lot of these like entrepreneurs who are very good at SaaS or whatever, who've done this many times. And so I think those entrepreneurs can justify the higher valuations, right? You're like, you've done this before, you've sold a bunch of enterprise or SaaS-related companies, and so that skill set accrues versus in consumer. And so I see a lot of that.
Yeah.
Again, I think I have strong views on this valuation thing and the funding and how it is increasing, but I think since it's the B2B thing, I'm going to pick up on his ideas a bit, and it's just a reflection, a thought of this B2C going to B2B, because if you remember, 7-10 years ago, all VC were mostly on the B2C side. But I believe there's been a lot of work well done by a lot of people who are working on social networks, on Google AdWords, Facebook ads, etc. And it's getting more and more crowded. So in the B2C, you have the channel problem.
Oh yeah, huge issue.
And it's getting more and more expensive unless you have a particular strategy. Again, make no rules. It's just an average, but it's true that it's becoming more expensive to acquire customers. There's still some arbitrage or at least some imperfections in the mobile acquisition channel. But on the online, proper laptop, desktop stuff, it's very difficult. And you give something that normally has not a huge barriers of entry as technology or product is. Whereas in the B2B sector, you can do something that is really for Cisco, for this kind of companies. And so it's going to be much more barriers to entry, much more difficult for other competitors, and much more easy to open the door. Okay, it's still a big corporate, but if you have the solution they really need, it's their job to open the door for you to come in and to buy this solution. So I think it's one of the few explanations of why we're going. I'm going to stop there. 6 minutes.
Yeah.
Yeah, I mean, I think we talked about this a little earlier. Like, what makes B2B investing or operating different from B2C? And I think as you know, for me at least, when I look at a B2B opportunity early, I think the intimate customer relationships that you can develop and understanding what customers are telling you when you have, you know, particularly, like, I actually like long sales cycles. I like long sales cycles if we can predict that they're going to come down later. Because if a long sales cycle results in a sale and a founder has a plan on shortening that sales cycle, there's a lot of learning that you get in that engagement with customers. Those long sales cycles, if you look at them as just a battle, it's not that attractive. But if you look at it as a process of defining a product so that you can sell it next time faster and learning from your customers, you're actually building up a proprietary knowledge base that your competitors may not have.
And stickiness after the
sale.
sale.
And stickiness,
they
right?
Stay with you.
So 100%. Yeah. And so those, what I look at a lot of times in these early stage deals is what do your customer relationships look like, and what can we learn from that about your business, your technology, your sales cycle, your ability to execute, et cetera. You don't really have those indications in the consumer space. So the things that drive successful consumer investing are the best ones I've ever seen. I worked up close with Saul and Robin Klein at Local Globe. Back when they were at Index, they're probably the best consumer investors I've ever worked closely with, and they are the best in the world at predicting the ability of a person to construct a brand. I think they're just outstanding at that. It's a completely different skill set. I was useless, right? But in the enterprise space, there's enough pattern recognition in that sales cycle with enterprise customers that you can start to develop patterns and maybe some predictability. And also for the company itself, for the founder, if you learn enough from that process, you can predict your sales cycle going forward.
We always speak internally that we don't want to dress up and make up as an older person than what we are. And many times, investing on heavy or intensive marketing companies in B2C from Spain with a 50 million fund, it's like shooting yourself, because you're going to lose the ownership that you have at the company, ourselves as a fund, so it doesn't make sense. So I think that's another reason why in Europe we also have this sense. If you want to fight globally as a B2C investor from Europe, with exceptions, we are not that big as other funds in the world. So I think we also have this angle also of, hey, maybe it's not our fight, and which also adds on top what they spoke about.
I mean, B2B is particularly interesting, particularly for Europe and Germany. If you look at a lot of the winners coming here, it's mainly on the B2B side, because you can get customers from anywhere, right? Corporate in the US is pretty similar to a corporate or enterprise customer in Europe. It's very relatively similar to a corporate enterprise in like Asia, right? Somewhere in Asia. They're fairly similar. So I actually think like Europe actually has a huge advantage in general from that. The design tends to be pretty good. Product, generally speaking, compared to the US, way better than, like, I see European versus sort of like US companies in competitors. Most of the time, the European companies tend to be way more capital efficient. And the second thing is actually, in general, the product tends to be better. The Americans just are much better at the sales and marketing piece, like way better at it, right? So remember that Larry Ellison joke, right? It's like, first you declare the market, then you declare yourself the winner, then you build the product, right? So it's just like, it is kind of the mentality, right? Like, but having said that, don't underestimate, this is something I'm very, very, I do talk about. Just like, Americans are like, they're great at sales process, great at sales, and if Europeans can really develop that, unstoppable.
Yeah,
really unstoppable.
I agree 100%, and I think the biggest opportunity for a European B2B company, whether you're from Spain or Poland or wherever, is to sell to the US early. Yeah. I think the mistake that a lot of founders make is to sell locally early and think that they're going to do the US in phase 2. Or think they're going to hire an American to help them in the US. And that's just wrong. Like, go to the US yourself, get on a plane, do it remotely, engage with the customers yourself. And then I think the proof point that you've generated, if you can succeed at that, it has tremendous significance, both with customers and with investors and with employees and your own learning, right? Once you've got the confidence that you can sell to the US, I met a Spanish company the other day that has no Spanish customers. All their customers are outside of Spain. One in the US and the other 10 other places, right? So that's very, very impressive and surprising for me to hear that they didn't even bother with Spanish customers, right? Nothing wrong with Spanish customers, but there's a lot more value in proving internationalization from day one, right? And I give the same advice in Israel. The best Israeli companies have no Israeli customers, and that's been a very consistent pattern with the more successful companies. And
we should also add too, if you get, this is for better or for worse, US customers are actually a better reference, it'll actually help your sales process actually back home too.
100%. Yeah. And I think it has to do a lot with the fact that Americans, despite Trump and despite the rise of Europe and everything else, the US is still by far the largest single market for enterprise software. They're the most early adopters, or the most meaningful reference customers. There's the most well-developed exit markets. They're the most acquirers for enterprise technology. They're the most VCs who know what they're doing for enterprise technology. There's just, I've done a lot of research on this. Over 90% of the exit value of European Israeli enterprise companies had some kind of US footprint, right? Which means if you are not having US footprint, you're now in less than 10% of the pool, right? So you need to go to the US early. And it's also the great leveler. Once you've done that, you're just as good as them, right? And it all is driven by the fact that Americans are ethnocentric, but use that to your advantage, right? The fact that they don't want to buy from you if you're not American, don't speak with an American accent, if they do buy from you, despite the fact that you have a Spanish accent, despite the fact that you're from Malaga or whatever, like, that's amazing, right? They will, you've shown that you're, that you're playing on that level, and then you'll get, your valuation will pop, right? So it's a massive advantage, right? Just play to that advantage, and then there's no better argument that you have the best technology in the world if you have not yet hired an American sales guy, you have an accent, and you can still sell to Goldman Sachs, right? That's super powerful. Yep. Everyone in Silicon Valley will take that meeting. Yeah, right? For sure.
I think we run already out of time. We didn't have the chance to cover verticals. Probably that would be for another occasion.
Next year.
But I don't know if we have time for probably one question or two from the audience.
The 20s.
We already are behind. One quick question.
Oh, it's not a quick question, but Ken Berger, it's my name, Lauren Labs. One big thing I heard is this impending bubble inflation. Do you guys anticipate a pop? Could there be a soft landing? It's not a short question. And what should people do about all of that to prepare themselves for whatever you think it's going to be?
Number one, I don't think any of us know. If we knew, I wouldn't be doing this. I'd just be like shorting stuff, right? But I mean, my answer is just make sure you have a business model that works. Make sure unit economics work as well too. Done. Then you're in good shape.
Again, I have strong views on this. I believe, that we're wrongly pushing towards the bigger super mega rounds, and this is normal. It's a big size bias in all the investment management industry. I don't think it has the amplitude or the size to be a bubble itself. I think many people are going to lose a lot of money in the biggest funds, but I think when capital markets will become again healthy, hopefully in 4 or 5 years' time, we will not be talking about. The thing is, there's a lot of appetite now, and I mean, all VC managers are also businessmen. So they want to increase their business, and it's normal. So they normally, I haven't seen VC funds that are doing smaller and smaller and smaller funds, okay?
Not by choice.
Bigger and bigger and bigger. And therefore, they cannot make seed rounds, 200,000 euros. I cannot, I have a 200 million fund. I cannot invest 200,000. And therefore, my fear is that the seed stage, early stage in Europe, which is not the most prominent area for VC funding, is going to be left a bit outside. And that's my fear, but it's not about a bubble. The bubble may be a bit into the big rounds, but we'll see, and we'll see that into 6, 8 years' time, really, not today.
I think your question was, what do founders do, given that we might have an explosion or a bubble pop, right? Yeah. So I think you as a founder have a responsibility to your business and to your shareholders and to your employees to run the business as safely and sustainably as you can. And I think the way to do that is to, first of all, run a business, not an endless fundraising project, right? Don't build your own personal plan on the fact that I'm going to raise $10 million in 2 years, right? Or in a year and a half or whatever. Yeah. Focus your business on, can I hit certain sales targets, and are those, at any given time, you should have some kind of a map to break even if you need to switch to that plan, right? Surround yourself. The other thing I'll say is surround yourself with employees, co-founders, investors, advisors, whatever, that know what they're doing and are deeply committed to the fundamental objective of your business and are not just there because they think that you're going to have some massive markup in 18 months because some fund with too much capital is going to throw $30 million at you without understanding what you do, right? I mean, I had a situation where I was an early stage investor in a company, and a VC fund showed up with a large check, and I asked, and the founder was like, I'm going to take it because it's a good enough fund that I want their money, and I couldn't stop him. But I asked him after the fact, I was like, when they wrote you the check, did they know what you did? He was like, no. right? And that's okay. Like, you know, he'll be fine, but that's dangerous, right? Too much of that gets very, very dangerous very fast.
Yeah. I will only add on top of what my colleague said is that the nice news for entrepreneurs, especially when they're starting, is that there's a lot of money, and there's going to be a lot of money for some years in the market. So we need to invest. I don't know if that will invest less or less valuation, but they will be money for the best projects. Yeah.
Okay, I think we almost achieved.
Like, I'm sure people would love to talk to you if you have time to talk afterwards. As it's lunchtime, lunch break now,
Yes.
so we have to.
Thank you.
Thank you very much.